By the way, we'll get another big auto number today, and I'm talking about Eicher Motors. Now, Sonia, considering there's so much of disappointment already, the stock has corrected so sharply from its dream levels. What kind of numbers should we brace ourselves for?
Well, I'm not the bearer of good news any longer because, it's just been one after the other consistent bad news. Even on Eicher Motors, in fact, the expectation is that the numbers will be weak. Eicher could report its first EBITDA decline in about 8 years. In fact, that's the reason the stock is also down almost 30% over the last 6 months. The revenues are expected to be flat, no growth at all this time. The EBITDA margins for Eicher could fall below 30% for the first time since March of 2016. So we're expecting not just an EBITDA decline, but an EBITDA margin of sub 30% this time around. Now, Royal Enfield volumes have contracted this time. They have fallen by 6% in Q3. It's a sharp deceleration from what we've seen in the past. In fact, the volume's around 6% at 194,000 units. And this compares to a 3.6% rise that we saw in Q2 and a 20% growth in Q1 and 24% in Q4. So if you look at the volume graph, it's been a slow and steady decline that we've seen over the past few quarters. The management says that high cost increase is because of the insurance cost, the disc brake cost. That has really dampened sentiment, but overall weak numbers expected.
Okay, so not looking exactly great. Again, similar story, Motherson Sumi stock has been rogered in the last several months. Numbers now?
Well, ever since Motherson came out last quarter with its numbers where the startup costs had gone up quite a bit in their overseas subsidiaries, the stock has fallen substantially. It's down almost 40% in the last 6 months. And this time around as well, although revenue growth will be fine, we're expecting about a 15% growth. It's on the margin front where the pressure will creep up. We're expecting a 70 basis points fall year on year in the margins and a 60 basis points fall quarter on quarter. So 8% margins is what we're looking at, and profit growth will be restricted to just 3.5% this time. Now, the key reasons for the slowdown is one, the standalone business has been quite weak, and two, SMR business, which is their rear view mirror business, has been under a lot of pressure. So it's a double whammy for them, which will hit their margins this time around. Higher startup costs. Remember, the startup costs for the SMR PBV business overall have risen to 20 million euros last quarter versus about 14 million euros in the quarter before. So if that continues to rise, then it will definitely put pressure on the margins this time around. And finally, the SMP business has done well. It also had the Radel acquisition, because of which the SMP business will have a better growth. But all in all, expect weakness this time around in their margins, and that's what the stock has factored in as well.